Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Twitter. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a Christmas tree butterfly with calls in Twitter. Now, that's a mouthful, and I'm showing the Christmas tree butterfly with calls inside the options playbook right now. It is by far the most advanced butterfly we've ever done on the Stock Play of the Day, but it really sums up what the Stock Play of the Day is all about, and the fact that I have penned the book, the options playbook. Inside the playbook, we have over 40 different strategies, and we try to come up with situations where one strategy might apply better than a different strategy. So it really comes down to, there's no golden book of answers when it comes to option trading. There's no one specific strategy that is the best option strategy. You want to look at the market conditions, and you want to look at the option strategies inside the option strategy section of the options playbook and come up with one that's going to fit what's going on in the marketplace. And the Christmas tree butterfly was a great example of what's going on with Twitter. So unless you've been under a rock recently and haven't been watching any of the financial news at all, you would obviously know that Elon Musk has made a bid for Twitter. It has been approved. He wants to pay $54.20, his little play on 420 overall. And he made that bid. The marketplace knows that's the top side right now until that bid falls apart. But he did it the week of Twitter's earnings. So we have Twitter's earnings that are out there, but we have a deal that is trying to get completed at that price. So they're kind of fighting each other. You're going to get some volatility because of the earnings, but we also know that the stock's supposed to be sold for $54.20. So how low can it actually go, and how high can it actually go? This number is going to kind of just suck in the prices as far as the stock is concerned. Now, that's what the thought was when we put the trade together. You never know what could actually happen when the marketplace is rocking and rolling. The bid could fall through. Somebody could come up with a better bid and try to compete. So there are obviously risks, but considering where the stock was in the news at that time, a Christmas tree butterfly made a lot of sense. And let's see what happened with the underlying stock. So if we look at the chart on Twitter, this is a 15-minute chart. We started at noon on Tuesday. We always do it live. We're always dealing with live markets when we do the Stock Play of the Day. And from noon on Tuesday for about the next half hour, we were trading right around $50. That's when we looked at putting on the trade. We wanted the stock to hang around $50 after earnings. Now, Twitter on Thursday morning before the open actually announced their earnings. Stock went down a little bit, but lowest we got down to was about 48. Came all the way back up to 49.89, back down to 49, up above 50 for a moment. And now here we are at 49.42. So today we hit the strike price on the butterfly. I would have obviously considered getting out at that moment, but we're not taping. We were not taping the Stock Play of the Day Overtime right at that moment. But when we started the call, it was at 49.75, and now it's dropped down to 49.43. So the question is, do you want to close it now, or do you want to wait and see if we can drift higher? I would have closed right here when it hit the 50. That's the point where we wanted it to be at. Might even consider closing it when we came close to that 50 the other day, but 1 day's worth of time decay on a butterfly is worth a lot. They don't max out. The only way that you can ever get a maximum on a butterfly is if it goes out right at your strike price, right at the expiration date. So it's going to be a short and sweet stock play of the day overtime, and we knew that because we picked this expiration on the 29th. Had to do with the earnings, implied volatility. There was a rationale behind why we used this Friday expiration, and it had everything to do with the fact that they were going to announce earnings on Thursday. So let's review the trade and look at what a closing trade would look like. Stock right now is at 49.43. It's up 31 cents on the day. The expiration that we chose was the April 29th expiration. We bought the 45 strike call. And once again, it was a ratio. It was considered a Christmas tree. So we bought one of those. We sold 3 of the 50 strike calls. That's where we wanted the underlying stock to settle at the end at expiration. And that's where the stock was at when we put the trade on. So there was a little method to our madness. And then lastly, we bought the 53 strike, which I just noticed I got the 53.5. They're trading for the same price though. They're trading for basically nothing. So this didn't really affect anything. And when we put the trade on, it was trading for 330. It's now 430. It was up as much as it was around 450. Well, I was watching it a little bit earlier while I was getting ready for the show. Of course, it just went down like the second we started the show. But with that said, you're up $1 on a trade. We had minimal risk when we put it on. We did know that it was $3.30 to put the butterfly on, and that was our maximum risk. We did have risk if it skyrocketed, and I'm going to run down and look at the profit and loss graph to kind of highlight that for you here. So here is the profit and loss graph. Let's regraph it. And adding that extra strike kind of screwed things up a little bit. So let me zoom out. Okay, so when we put the trade on, we had limited and known risk if the stock went down below 45. But once again, that's hard for the stock to do considering somebody's willing to pay $54.20 for it. On the upside, we did have a little bit more additional risk. When we got up to 53, oh, that's what's going on. I understand now because I got to add 2. Okay, so when we go up to the 53 level, well, from that point, we have an additional risk in that just another extra $1. But from 54 on up or 53 on up, we have limited and known risk on the upside. And we know that basically until something happens with the deal, that the stock's probably going to trade somewhere below 53, just because the deal says we're going to go out at 54.20. Very rarely is it going to stay there. And there are a lot of if, ands, or buts as far as this transaction is concerned. So the trade is a 1x3x2 on Twitter that we're looking to do. We go back to here, 1x3x2, we got it there. All right. So now let's put the trade in and let's look at exiting the trade. We're up about $1 on a trade in 4 days. We paid $3.30 for it. That our maximum risk would be $4.30. With this situation went down, it was $3.30. So how do we close it? Everything that we bought to open, we're going to sell to close. So we go in, we hit sell to close. Everything that we sold to open, we're going to buy to close. So we go sold to open, we go buy to close. Buy to open, we had this. So this is a sell to close. And the trade would be, we're selling to close 1 of the April 29th 45 strike calls, buying to close 3 of the 50 strike calls, selling to close 2 of the 53 strike calls. We always want to work at a midpoint or somewhere around that area, never a guarantee of a midpoint fill. The options are fairly liquid because of all the news that are in them. There's a decent amount of open interest and volume. So let's go 430, make it, if we were to exit and we could get that price, means we'd be up $1 on our trade. Maximum that it could trade for would be $5. So if you rode it all the way to the end and it went to the 50 strike and stopped right there, well, then the maximum you could have made on the trade would be the $5 minus the $3.30. So that would be a $1.70. So we're not doing bad. We're up $1 on the trade. If we were up $1 at any point in time during the trade, we would have got out of it. No reason to try to make the maximum because it's almost impossible for the stock to stop right at 52. So first time doing a paper trade, Christmas tree butterfly on the stock play of the day. But the scenario fit. We probably won't do too many of these. But one of the biggest things why we did a 1x3x2, and let me just emphasize that, is that these option contracts right around the 53, 54, 52 area were trading for next to nothing. And we had to buy them. Why? Because they gave us protection. So we went deeper in the money, got some intrinsic value on this side. Notice this is a 5-point wide spread. And on the short side, we were able to put on a decent spread and not have to pay that much for the leg that we had to buy to protect us. So because of that, the Christmas tree just worked out. And hence the stock did actually stick right around the 50 level, which we were hoping would happen even after the earnings report because of, once again, the known buyout number at 54.20. So simple, straightforward stock play of the day. Overtime, we'll be back for Tuesday's stock play of the day. Click subscribe, ring the bell, and we'll see you this Tuesday for the next stock play of the day. Thanks for coming, everyone.